Welcome to ETF Edge, your go-to place for all things ETF related. I'm Seema Modi, filling in for Bob Pisani, and it is the final trading day of the month, and markets continue to tread water amid debt ceiling drama in Washington, global recessionary fears, and interest rate uncertainty. But there's plenty of movement below the surface. All month long, bonds have looked like the best game in town, with fixed income ETFs enjoying massive inflows. And non-U.S. equity ETFs have seen stunning outperformance over the U.S. What's the market set up for June? Joining me now is Dave Mazza, Chief Strategy Officer at Round Hill Investments, John Davi, CIO of Astoria Portfolio Advisors. Great to see you both. John, first to you. Help us break down some of the flows you're seeing right now. Despite the big run-up in tech stocks, large cap ETFs have surprisingly seen outflows this year. So explain why that is.
Yeah, I think there's, like, if I'm defining 2023, I see kind of three big trends. First is you've got bonds that on a per unit risk basis are attractive relative to, say, broad-based U.S. equities. Why? Front-end rates are trading very high, right? Fed has jacked up interest rates. You can clip, a T-bill and get 5%, take no risk, right? So that's troubling for stocks, let's say, in the U.S. So as a result, you've got, 82 billion of inflows into bonds. Equity ETFs have only taken in like 55 billion of inflows, right? That's a very big difference from what we're used to seeing in prior years. The second big trend that I see is this, kind of non-U.S. over U.S., right? So let's talk about U.S., right? I think the macro picture in the U.S. is a little bit murky, right? You've got this bifurcation in some of the macro data, right? Some macro data is good, some of it not so good, right? So I think, like, the international markets are much further behind the interest rate cycle and the inflation cycle. So as a result, you tend to see a lot of flows into non-U.S. ETFs, right? So 40 billion into non-U.S. in aggregate, whereas U.S. broad base is only taken in like 14 billion. Some of these single country ETFs like EWI, EWP, EWG, right? These are single country European ETFs. They're up 15%, right? The one we use, IHDG, which is kind of broad developed international markets, is up 11%, right? The U.S. is basically, the broad-based S&P is being driven by 7 stocks, right? And we're going to talk about that with Dave with his product. But, so it's just a lot cleaner in the non-U.S. market. The final thing I would say is like this rotation out of value, into growth. And I think, we're starting to see like, these energy ETFs, 8 billion of outflows, broad-based tech, not a lot of inflows relative to the move, but you really got to break down tech, and you start to see the semis have taken in some inflows. But broad-based, I would say, like, when I look at the Qs, which is the big institutional product that people are going to trade, in size to get risk on, risk off, it trades like water. That's taken in it's seen about 2.5 billion of outflows. And even if I start adding in like the levered Qs and then, the mini Q, which is QM, there's just not a lot of inflows into tech on a relative basis, relative to that 30% move in the Qs year to date. So that's how I define kind of what I'm seeing on the flow front.
And Dave, what are you watching as we head into the summer? Next big catalyst, especially as the dust hopefully settles on the debt ceiling negotiations.
Yeah, no, that's a great point. And I think John hit a few topics which are relevant here. I've defined this market 2023 as a haves and have-nots market. And we've seen this across sectors, across industries, and really across the globe. And the haves are companies that are really scooping up all the interest. We're obviously seeing it with AI, exposed companies versus non. We're seeing it with growth, beating value by 22% year to date. Technology sector trouncing energy. And a lot of this has to do with the interest rate environment. We were in a time with zero interest rates where a rising tide lifted all boats. You could pick a sector, you could pick a stock, and you may outperform. It didn't matter as much. Now fundamentals and the macro matters significantly. And going forward, I think this is going to only continue to be the case, which is why investors likely need to be more selective here. I think we've been fortunate that volatility has been low. Hopefully this debt ceiling is just another debacle. I think up until today, the market has really ignored it for the most part. We obviously have a vote this evening, which is going to be relevant. But usually time and time again, barring some exogenous event, we move on from it, and then markets begin to really focus on the data. And to John's point, it's been a bit mixed.
Tech and communication services have been the big winners in the month of May, powered in large part by a surge in enthusiasm over AI. More and more ETF issuers are getting in the game, rolling out new products that offer exposure to AI-centric companies, an especially timely endeavor after a number of tech stocks, including NVIDIA, rode the AI hype train to new highs last week. NVIDIA just topping the $1 trillion mark in the overall market cap. Roundhill Investments has just expanded its lineup of thematic offerings by launching a new generative AI ETF, ticker CHAT. And Dave, you run that fund. Your goal here is to make this ETF sort of a pure play product. Tell us about it.
Yeah, no, happy to do so. So the Chat ETF, and the ticker is CHAT, is focused on companies that are at the forefront of generative AI. The term AI has been around for a while. There's existing ETFs focused on AI and robotics, but nothing on the killer app, which is the generative AI and ChatGPT. It's the fastest growing application to 100 million users, faster than Uber, TikTok, and really all the applications and technologies that we take for granted at this point. And what we're doing is looking to seek out those companies. Investors will see around 25 to 50. There's around 30 names in the portfolio today that are focused on generative AI. And so there's going to be names like NVIDIA, which is providing the chips that are required for this revolution. Names like Microsoft, of course, which has an investment in OpenAI's itself. And then other names, C3AI, which is an AI-exposed company. You're going to see, of course, in the top 5 holdings, a name like Alphabet, with their working with their Bard, and AMD, another chip maker. But if you actually go down the list, there's going to be many names that are smaller, more mid cap, perhaps even some micro cap companies in there that have that AI exposure. This is an area that's going to get a lot of attention. We already are seeing it. Look at the valuation multiples of NVIDIA. But these companies, we believe, are not just a fad. They're powering something that could be as ubiquitous as the internet itself and as something like the iPhone. And it's not just us saying this. It's research firms like Goldman Sachs and others, and CEOs of Fortune 500 companies who are working on their AI strategies today so that they're not left behind in the future.
John, what do you think? Do you foresee real investor appetite for these more targeted ETFs rather than exposure to the watered down ETFs that are largely concentrated in mega cap tech names? Are these enough or good alternatives?
Well, so I like a lot of the stocks in Dave's ETF, and we own a lot of them in our quantitative stock portfolios. I think, like, when I look at, like, the Chat ETF, like, the key there is, like, a lot of those companies are profitable, right? I think, like, 2-3 years ago, it was all about disruptive growth. Those are unprofitable tech companies, right? Small, kind of micro cap, mid cap, not a lot, like hopes and dream stocks. Whereas I think, a lot of the stocks that, in Dave's ETF, like, these are the big bellwethers, right? So if you can get like a much more narrowed, focused way to kind of play it, like, I'm a supporter of it. So I think there's going to be a lot more ETFs to come in this space. I mean, there's at least 4 or 5 that have the word AI in the ETF name, and then there's countless others that give you exposure to the semiconductors. But this is what the ETF industry does, right? It launches a lot of products, and you got to really look under the hood and make sure you're getting that exposure to this generative AI. And Dave's firm seems to be doing that pretty well so far. So,
Dave, are there any regulatory hurdles along the way? We just saw a statement released by the Center for AI Safety signed by more than 350 leaders, researchers, engineers, warning about the risk of extinction if things get out of hand.
Yeah, I think we're still at the early stages of seeing generative AI expand into areas where you could see impact negatively on humanity or the world itself. As of right now, and I think John raises a great point, the companies that you're going to find in this portfolio are highly profitable companies with existing revenue streams, and in many cases, like NVIDIA, moats around their businesses on the AI side, on generative AI side, that other companies are going to have a hard time disrupting. So we're not talking about hopes and dreams, some theme or fad that could happen 30 years in the future, which may change the world. This is happening today. Grandmas and grandpas, college students can all use ChatGPT. It's so easy to use. It's ubiquitous. And so, yeah, time will tell. Regulations may come into this space. But I think people are realizing that this isn't necessarily displacing what workers can do or what we can do as consumers. It's complementing it. I heard a great quote actually coming out of a company saying what ChatGPT can do, or what I should say generative AI and large language models can do, is make everyone a power user. And how great is that? I might just not necessarily need to have expertise in that particular technology or that space, but I can lean on this as an assistant, as sort of a chatbot to help me make better decisions, whether that's in the medical field or working on an insurance claim.
John, when you think about AI, is it a sustainable long-term bet in this market? I mean, Goldman just came out with a note today saying they believe AI could add $7 trillion to annual global GDP over the next 10 years.
Yeah, I mean, I think technology, is going to make everyone much more productive, streamline your workflow. Some of these mundane, routine systematic tasks that would take a human to do, it's probably just better off using ChatGPT. So even internally in our firm, I'm starting to encourage everyone to, let's try and use ChatGPT just to kind of streamline our processes. So I don't think it's a fad per se, but I'd be remiss, Seema, if I did not say, as a kind of global macro investor that pays lots of fundamentals, I am kind of concerned about some of the fundamentals of some of these stocks, because I think a lot of it's in the price. So, just be careful. Like, again, we own some of these stocks in the chat ETF, but, we've either been long them for a while and we've been the beneficiary of this move of late. But, to be buying it now, like, you just have to pay attention to fundamentals and what price you're getting in at.
Good advice on both sides. That does it for us on this week's ETF Edge. I'm Seema Modi, and for Bob Pisani, my sincere thanks to John and Dave for giving us their lens into what's happening in the ETF world. Thank you for watching. You can find all the latest videos right here on our website, etfedge.cnbc.com. We will see you next Monday, same time, same place. Have a great weekend.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.